Welcome to this Everyday Rupee Explainer. We're jumping straight into a tax season survival guide today. 3 parts: finding your perfect tax regime, decoding Section 80C, and figuring out if your taxes actually due before you even file. Let's get right into it. Here is the roadmap for today. 1. Old versus new tax regime. 2. Section 80C. And 3. TDS versus advanced tax.
Let's kick things off with Chapter 1, Old versus New Regime. Which one actually fits you?
Okay, so every single filing season, you've got this choice staring you in the face, right? Old regime or new regime. You're taxing the exact same income, just under completely different rules. Look at the old regime. It hits you with higher base tax rates, but, and it's a big but, it lets you shrink your taxable income first. You get to claim deductions for your home loan interest, those ADC investments, house rent allowance, the works. Now, the new regime completely flips the script. It gives you lower tax rates straight out of the gate, but almost all those handy deductions, poof, gone. Basically, what you earn is a lot closer to what gets taxed directly. To really see how this plays out, let's look at 2 totally different people. Meet character A. They've got a home loan, they're heavily invested in ADC options, and they're claiming HRA. They've got a solid stack of deductions lined up. Now, on the other hand, meet character B. No home loan, no major investments, not paying rent. Character B has, well, practically nothing to deduct. So, what's the actual bottom line in rupees? This is where it gets super interesting. Under the old regime, all those stacked deductions pull character A's taxable income way down. So even with those higher rates, the smaller base amount means character A actually pays less overall. It's a win. But character B? If they use the old regime, they have 0 deductions to soften the blow. Their full income gets slapped with those higher rates. Ouch. But under the new regime, character B's income gets taxed at the lower rates directly, making it the clear winner for them. Same tax code, same year, same income amount, but the better choice completely reverses depending on who you are. Honestly, this just proves a massive point. There is absolutely no single universal winner here. You can't just copy what your friend is doing. It depends entirely on your own specific deduction profile. You know, most salaried folks can actually switch between these regimes every single year. You are not locked in. But let's be real, most of us just default to whatever we did last year without even running the numbers. You could literally be overpaying the government right now just out of habit. 2 regimes, same income, wildly different outcomes. The only way to know for sure is to do the math and calculate both. All right, moving right along to Chapter 2, Section 80C, and what actually qualifies. Now, a lot of those deductions that make the old regime so attractive have very specific rules. You hear ADC thrown around constantly this time of year, right? And most people kind of assume it's one specific type of investment. But actually, scratch that. It's something completely different. Section 80C is not a single investment. Think of it more like one big shared bucket. So many different things actually get tossed into this exact same bucket. Your workplace PF contributions, your public provident fund or PPF, life insurance premiums, those ELSS tax-saving mutual funds, the principal on your home loan, even your kids' tuition fees. All of these different products are pooled together into one combined limit. And this is where so many smart people make a huge mistake. Let's bring back character A. Every month, their PF contribution and life insurance premium get deducted straight from their salary, automatically, without them lifting a finger. Those 2 things alone are quietly filling up a massive chunk of their ADC bucket in the background. But then, character A goes and dumps a ton of money into ELSS, specifically trying to grab an extra tax deduction. The problem? That bucket was already practically overflowing. The ELSS is still a perfectly valid investment, sure, but it adds 0 new tax benefit because there's just no room left in the ADC bucket. This exact trap catches so many of us. We assume every single HSA-eligible product stacks its tax benefits separately. But no, they are all fighting for the exact same limited space. It's one bucket, not separate ones. Once you hit that cap, extra contributions just spill right over. You get 0 additional tax benefit for them. So, what's the smarter play? Before you rush out to buy some specific ADC tax saver, check what's already filling your bucket automatically from your salary. Check that PF. Check those existing insurance premiums. Your goal is to fill the bucket exactly to the brim. Don't overflow it and don't leave empty space if you don't have to. ADC isn't a list of separate perks, and most of us are way closer to the limit than they realize. Which brings us to our final chapter, Chapter 3, TDS versus advanced tax.
Let's look at those collection points. Okay, imagine this. You do a little freelancing on the side. Tax season rolls around and boom. You find out you were supposed to be paying taxes all year long. Surprise! Here's why that happens. We essentially have three distinct collection points in a financial year: TDS, advance tax, and self-assessment tax. TDS, tax deducted at source, is taken out automatically before the money even hits your bank account. It happens with salaries, bank interest, and big freelance payouts. Then you have self-assessment tax, which is basically the mop-up phase. It's whatever tax you still owe settled up in one final payment when you actually file your return. But then there's advance tax, and this one really trips people up. This is tax that you have to calculate and pay yourself in installments spread across the 4 quarters of the financial year. And this kicks in if your total tax owed isn't already fully covered by TDS. Let's look at our characters one last time to really nail this down. Character A is salaried. Their employer handles TDS automatically every single paycheck. They don't have to calculate anything ahead of time, and their TDS usually covers almost the entire tax bill. For them, filing season is mostly just confirming the math. But Character B, our freelancer, their client payments might have TDS deducted or they might not. There's no employer playing accountant. If Character B's total tax bill crosses a certain threshold, advance tax kicks in. It is entirely on them to estimate their earnings and pay those installments throughout the year. They cannot just wait until filing time. And here is the kicker, folks. If you miss those quarterly installments, you can get hit with penalty interest for paying late. And yes, that happens even if you pay the full amount perfectly in rupees when you finally file. Being late literally means extra cost. The bottom line here is pretty straightforward. TDS is automatic. Advance tax is your responsibility to figure out ahead of time, and self-assessment just settles the final tab. If you have any income stream outside of a regular, plain vanilla salary, do yourself a favor and check early in the year to see if advance tax applies to you. Do not wait until March. For a lot of folks, taxes are a year-round event, not just a once-a-year headache. All right, let's quickly recap our survival guide for this explainer. Step 1, run your actual numbers to pick the regime that genuinely fits your deductions. Step 2, treat Section 80C as one single, shared bucket. Fill it, but don't blindly overflow it. And step 3, remember that tax collection isn't always a once-a-year thing, so keep a close eye on those collection points. So, which of these 3 concepts surprise you the most? Are you maybe leaving some hard-earned rupees on the table by blindly carrying over last year's default tax regime? Let me know which of these you're going to fix first down in the comments. And hey, if this explainer helped you out, make sure to subscribe. We're dropping one new money concept right here every single day.